So now let's discuss how double entry accounting works in accounting software. Double entry accounting in accounting software works by automating and simplifying the recording and tracking of financial transactions using the principles of double entry system. So first and foremost, um, once a business has opened or has an account on a specific accounting software, the first thing that they should set up is the chart of accounts. So once you sign up for an accounting software, they will ask you what kind of business are you in, because they have this predefined or customized chart of accounts, which includes various categories and subcategories of accounts based on companies' specific needs. So, for example, if you are an e-commerce business, your chart of accounts will be different from an accounting practice or from a legal practice. Recording of transactions. When a financial transaction occurs, such as a sale, purchase, or expense, the user enters the details into the accounting software. The software prompts the user to select the appropriate accounts and enter the corresponding amounts. So, for example, you paid your bill. For example, you paid your electricity bill. So all you have to do is to prepare the bill. The details, you should enter the details on the appropriate accounts and enter the corresponding amounts. And after that, once the transaction details are entered, the accounting software will generate the necessary journal entries automatically based on the selected accounts and amounts that you entered. This ensures that every transaction is recorded with the appropriate debits and credits. So after the recording, the accounting software will automatically update the ledger, the general ledger, which is a central repository of all accounts and their balances. The debits and credits from the journal entries are reflected in the respective accounts. So it keeps track of the financial changes. So as each transaction is recorded, the accounting software keeps track of the debits and credits in real time, ensuring that the accounting equation remains in balance. With the accurate and up-to-date data in the general ledger, the accounting software can generate financial statements such as the balance sheet, income statement, and cash flow statements. This provides a comprehensive view of the company's financial position and performance. The accounting software often offers a range of reporting options, allowing users to generate customized reports and analyze data. So this helps business monitor their financial health. Okay, so back to reporting. Uh, the accounting software will help track or monitor the financial health of the business, track key metrics, and helps the decision makers to make informed economic decisions. So by using by using an accounting software, the double entry bookkeeping and accounting becomes more efficient and less prone to errors because this software automates the process. It eliminates the need for manual calculations and provides real time visibility into financial transactions and records. So, this also streamlines financial management and ensures accurate and reliable financial reporting. So if you remember in our video about um, the accounting cycle, there are at least 10 steps in the accounting cycle from the analysis of the transaction up to the post-closing uh, post-closing trial balance, right? So uh, these 10 steps are streamlined. So for example, when you are using an accounting software, the only thing that you have to do is to the enter the amount to the right account, and that's it. The journal entry, the posting, after the preparation of the financial statement, the statements and other reports will be made by the accounting software. So, in essence, the accounting software will help you streamline the preparation of financial statements and helps the management to have accurate and reliable financial reports. Let's go to this topic: how to read and interpret the transaction journal and general ledger in accounting software. Later, I'm going to uh, demonstrate to you where you can find this transaction journal and general ledger in the accounting software. So, the transaction journal, first you have to understand the layout. The transaction journal typically displays the date, the transaction description, the accounts affected, and the corresponding debit and credit amounts. You have to review the entries. Read each entry and identify the accounts involved. You should note the debits and credits recorded for each transaction. Next, you have to verify accuracy. Ensure that each transaction follows the double entry accounting principle with total debits equal to total credits. Next, you have to analyze descriptions. We should pay attention to transaction descriptions to understand the nature of the transaction and its impact on specific accounts. Because in the in entering the data in the accounting software, it is still manual, right? So we could not do away with uh, errors also in entering the accounts, the description, and the amount. So we still have to verify its accuracy and analyze the description. Next, we have the general ledger. First, we have to identify the accounts affected. The general ledger lists all accounts used by the company. So we have to locate the accounts mentioned in the transaction journal. Next, we have to check the account balances for each of the account. We should note the initial balances as well as any changes resulting from the transaction journal entries. Next, we should review the debits and credits recorded in each account. We should make sure that they match the corresponding transaction journal entries. We should also calculate the running totals for each account to track the cumulative impact of transactions over time. We should also analyze account movements. We should look for patterns or significant changes in any account balances. We should ID accounts with increasing or decreasing balances and assess their impact on the company's financial position. So we are on the QuickBooks Online of Craig's Design and Landscaping. So let's look at the register of Craig. He's using checking, savings, and MasterCard. So on his checking account, this is the general ledger of all the accounts that affects his checking, and this one, those that affect his savings. And under the MasterCard, you have these transactions. So let's create an expense. So before that, let's go ahead and take a look at his profit and loss. Okay, so this is the income of Craig. The total income is 10,000. And his expenses are the following. Okay, so let's say that let's record an expense of legal and professional fees. So this one, please take note that this is $75. So let's go to expense, so that you'll know that once you record an expense here in QuickBooks, the financial statements is also updated. So let's record a new transaction. It is checking. Checking account, yes. Okay, so let's save and close. Okay, so this now, in the register of the company, you see the legal and professional fee that we currently have, that we had just made. So let's take a look at the report. So the legal and professional fee is now 150. So now you see, we only prepare the expense and the register, the general ledger of the company is updated. Let's take a look at the general ledger. Okay, so we prepared this one just now. It's updated already. And also the financial report, the profit and loss for the month. So this one is updated. So as you can see, we only recorded the expense, and everything else, the general ledger, the journal entry, is updated up to the preparation of the financial statement. Okay, so let's take a look at the transaction journal entry. Okay, so this one is the transaction journal entry about the expense that we made. So we debited the expense in the amount of 75 and the checking account of 75. Okay. It did not affect the accounts payable account because we paid it readily. Okay, so that is the transaction journal entry for our expense transaction. So let's take a look at the ledger of the company. Okay, we have to look at this one is uh, the transaction that we have just made for PAM. This is the ledger, the general ledger. So once we recorded the expense transaction for the payment of legal and professional fees to PAM, the general ledger is readily updated, as you can see here, and also the transaction journal the uh, for the expense that we made, and also um, the profit and loss statement. So where is that? So before, this is just 75. When we recorded the another 75 legal and professional fees, this one is also updated. So that is the advantage of using QuickBooks, and also not only QuickBooks, if you are using also other accounting software, the effect is the same. You only record or enter the correct amount to the right account, and then all the other process in the accounting cycle is streamlined. So all you have to do is enter the correct amount to the right account, and that's it. The accounting software will prepare the journal entries, the posting to the ledger, the trial balance, and the adjustments also made. The adjustments will be made by the accountants, and then the financial statements will be readily prepared by the accounting software. Okay, so here are some tips on how to interpret the transaction journal and general ledger in the accounting software. First, we have to compare entries. We have to cross-reference the transaction journal and general ledger entries to ensure consistency and accuracy. Next, we have to analyze trends, identify recurring transactions, and assess their impact on specific accounts over time. So, an example of a recurring transaction is when you have a client in which you invoice for in which you invoice monthly for the same amount. This is a recurring transaction. So for example, if there is an increase in that amount, it means that you have uh, you have an increase in the number of hours that you work for this client, or he, he may that client may have uh, may have overpaid you. So we have to assess the impact of these transactions on the specific accounts over time. Next, we have to monitor account relationships. We have to understand how transactions between different accounts affect each other. So, for example, if you have uh, a sale on account, the amounts or the accounts affected here are the revenues, your accounts receivable, and your inventory. Next, we have the financial statement preparation. So the information in the general ledger is used to prepare the financial statement, such as the balance sheet and the income statement. So by analyzing the account balances, we can be able to understand uh, each of these how each of these account balances affect the preparation of the financial statement. So if you remember, in the preparation of the income statement, uh, we place the accounts that will affect the income statement are your revenues and expenses. And the balance sheet, the accounts that will affect your balance sheet are your assets, liabilities, and equity. So that's it for this topic. Thank you and see you on our next video.